The next topic under technical analysis is chart patterns. Now, there is a difference between chart patterns and candlestick patterns. Chart patterns are geometric shapes found on the price data that can help a trader understand the price action, as well make predictions about where the price is likely to go. And candlestick pattern, on the other hand, can involve only one single candlestick or a group of candlesticks which are formed one after the other. Now, not knowing what chart patterns are forming can be a costly mistake, because you are completely unaware of what is forming on the chart, and you end up taking a trade that is not in line with the chart pattern it's signaling or telling you. And then you talk about the 9 chart patterns and explain everything graph.
The first chart pattern we will be looking at is the triangle chart pattern. We have 3 types of triangle chart pattern. We have the symmetrical triangle, we have the ascending triangle, and the descending triangle. These are the 3 triangles we have, and we'll be looking at them closely. In order to understand how symmetrical triangle is, I believe you must have understood how support and resistance works. Now, symmetrical triangle are based on support and resistance. I'll now clean this so that we'll get to see how to spot our triangle chart patterns. Okay, for example, the chart has been bullish, and then it meets a resistance. Then price then begins to pull back and then meets a support level, and then pulls back again, then drops, pulls back, drops, pulls back, drop, pulls back, drop. After this bullish trend, price began to consolidate. It started moving sideways instead of bullish or bearish. Now, if you use your trend line, you discover that this is a linear resistance. We said we need just minimum of 2 highs and 2 lows to draw a linear resistance. If I clean this horizontal resistance like this, you discover that this is a linear resistance. And if I continue drawing it down to this place, we discover that the linear resistance is going downwards. Now, for this linear support level, we'll draw it like this. You connect this low with this low, with this low, with this low, with this low, and then they will all meet at this point. Now, this is how symmetrical triangle is formed. This is the symmetrical triangle. Now, if this chart pattern should pop up on your chart, it means 2 things. Is either price will break the structure and continue pushing above, we'll have a breakout of this bearish resistance and then a retest, which will now be our support level, and then price will continue going upwards. From this level, it pushed, then this is a pullback for it to recharge for the next push, whether up or down. Symmetrical triangle is both a bullish and bearish reversal chart pattern. If this chart pattern should form on your chart, you should expect the breakout above or below, a breakout, a retest, then it goes down. Now this is how symmetrical triangle is. It's based on linear support and resistance. And then the next triangle, which is the ascending triangle, this is formed using a horizontal resistance and a linear resistance. Let's see, price has been going up, meets a resistance at this level, and then it drops, it pulls back, it drops, pulls back, it drops, pulls back, drops, pulls back. Use your linear support level to draw your bullish support level. Now I'll connect this pullback with this pullback with this, which you can see that the linear support is going up, it's ascending. I earlier told you that this chart pattern is formed using a linear support. You connect this with this with this with this. As you can see, this resistance is a horizontal resistance, it's going sideways, while this is going upwards, it's ascending. Now this is a triangle, isn't it? Now this is why it's called ascending triangle. Most at times this is a bullish continuation chart pattern. It tells you that the market is making higher highs. This previous pullback did not come below this point. This pullback did not come below this point. This pullback did not come below this point. This is telling you that the trend is bullish and it might continue going upwards, and you most likely have your breakout above, and then you have a retest, and then it will continue going up. This is how ascending triangle is. Descending triangle is the opposite of the ascending triangle. You have a bearish trend, then market pulls back and then pulls back again. It pulls back again, pulls back again continuously. Then we'll have horizontal support and then our linear resistance, giving us a bearish trend. And this is how a descending triangle is formed. Now this chart pattern tells us that the trend will most likely continue going down, because like I explained during the ascending triangle, this pullback did not pass this previous high. This pullback did not pass this previous high continuously. This tells us that the trend is going bearish and it's not good to trade against the trend. The trend is always your friend. The next chart pattern we will be looking at is the double top and double bottom. And this double top is formed when price has been going up for a while. It meets a resistance level, and then it pulls back, and then it goes back to touch that same resistance it earlier touched, giving us the second top. And then this will be our first touch, this will be our second top. Now if this forms, it's most likely telling you that, oh yes, price is about to respect this resistance. And then if you find any of your reversal candlesticks or reversal chart patterns above here as this resistance, after this double top, price will most likely go down. It will break this support level and then go back for retest before going down. This is how double top works. You know what it means. It's a very simple chart pattern and very easy to spot on your chart. The opposite, which is double bottom, it forms when price has been going down, it meets a support level, it pulls back, comes back, second top. This will be our first, this will be our second, and then price will go back up. These chart patterns are reliable when using both candlesticks and your chart patterns and market structure to try and understand what the market is telling you. The next candlestick we'll look at is the triple top and the triple bottom. As the name implies, it's usually formed after having a triple top like this. After a resistance, price has been going up for a while, and then it meets a resistance, gives us the first, second and third touch, and this tells you that price is finding it difficult to break this resistance, and price will most likely go down after respecting this resistance. And the same thing goes for the triple bottom. It's the opposite of the triple top. How to trade this: you can wait for the price to break below this support level. After it's gone back for the retest, then you sell. You place your stop loss above this resistance, and then you take profit at the nearest support level. Let me quickly draw the triple bottom. It is usually formed after a bearish trend. It makes a support level, it pulls back, giving us the first touch, comes back, pulls back again, respects this support level, giving us the second touch, comes back and respects this support again, and then at this point we will watch out for our candlestick or chart patterns. Most reliable, you can watch out for your shooting star, your doji, your spinning tops, your reversal candlesticks. If you find any, then you can trade from this support level, or you wait for a breakout of this resistance and then a retest, then you buy, you place your stop loss below this support, and you'll take profit above the nearest resistance. Now the next chart pattern we will look at is the bullish flag and the bearish flag. Now let's first start with the bullish flag. It is found after a bullish trend. Price begins to pull back, recharging for the next push. It begins to pull back, and then by so doing it will form a bearish channel. We'll have a bearish resistance, now a bearish support. Now from this point to this point is the pole. Then this channel will be our flag. This is how simple bullish flag is. This is the bullish flag. Now this is formed after a push up, and then we'll have a bearish channel. The channel will be our flag, the impulsive push up will be our pole, and then this is mostly a continuation chart pattern. If this should form, expect a breakout above. You can trade from this support level, you can buy from here, and then price will go up, and then you can take profit, or you decide to leave your trade. You can move stop loss above your entry to break even, so that even if price should decide to come back down, you will not be in a loss. For the bullish flag, it's a continuation chart pattern. Price will break above, a retest, then push higher to break this previous high. Same thing goes for the bearish flag. It's the opposite. It is formed after a bearish trend. It will form a channel. This will be the pole. This will be the flag. And this is formed after we have found our bullish channel, and you can trade it by selling from this resistance, then it will break out below, retest, then continue going down. Or you can decide it's better if you wait for a breakout and then a retest, then you sell. Place your stop loss above your entry and your take profit at the nearest support level. And this is how the chart pattern is formed. After a bearish, then we'll have a bullish channel, and by so doing we will have a bearish flag. Let me talk about the last chart pattern that we will be looking at, the head and shoulder pattern. And this is how it is formed. You have a bullish move, you then have a pullback, which will give you the left shoulder. You price them, breaks above, pulls back, giving you the head. This will be the head. Then price will go back to this resistance, giving you the right shoulder. Then price will pull back and then break this support level, go back for a retest, and then drop. This is the head and shoulder pattern, and this is the left shoulder. I will have space. This is the right shoulder. This is a bearish reversal chart pattern. After price has been going down for a while, it will meet a resistance, then it will pull back to this support level to then push higher to maybe a significant resistance, and then go back down to then come back and break this support level, go back for a retest, and then head downwards. The same thing goes for the opposite, which is the inverse of this, which is the inverted head and shoulder pattern. This is formed at a resistance. The same thing will happen. The head will form and the shoulders will form. This will be the left shoulder to push down, giving us the head, then come back down to this support, giving us another shoulder, then it will break this resistance, come back for a retest, and then go back up. Shoulders. This is the inverted head and shoulder pattern. This is a bullish reversal chart pattern. If this should form at a support level, or the main head and shoulder should form at a resistance level, this is telling you that price is about to go the opposite direction. Now, all these chart patterns that we have discussed, you can combine them with the use of your candlesticks, market structure, Elliott waves, and you can find nice entries. Don't forget to use the high time frames for your analysis and go back to lower time frames for your entries, either a buy or a sell trade.